Bismillahir Rahmanir Rahim. Assalamu alaikum, my dear students. Now, in our previous lecture, we concluded our discussion about introduction to macroeconomics. We looked at the historical background behind the evolution of macroeconomic thinking. We went back to the 1930s, to the times of the Great Depression, and to how Keynes introduced ideas that were then taken on in the mainstream, and macroeconomics as a subject was born. Now, the lectures that I gave you, the 3 lectures, are very interesting in the sense that they will give you a lot of pleasure when you read them after the end of this course. So that after you've taken these 21 lectures in macroeconomics, if you go back and review those 3 lectures, they'll give you a lot of fun, because you'll understand them better. Some of the concepts embedded therein will become clearer to you because you've understood the issues a little bit better. Now, the agenda for today is as follows. I'll start by doing a little recap on what we learnt in our previous lecture. Then I'll give you an outline of the remaining 18 lectures, that is, including the lecture for today. And then we'll start by discussing macroeconomics proper. That is, we'll develop ideas about national income accounting, and then we'll see how we can develop a model for the national economy. Let's start by doing a recap of what we learnt in our previous lecture. Now, if you remember, we noted that the major difference between Keynes and classical economists happened in 3 important markets: the labor market, the market for loanable funds, and the aggregate goods and services market. Particularly in the labor market, classical economists said that wages were not falling enough to the level that would clear the market. That is, the economy was out of or off its full employment level, mainly because wages were sticky downwards. And the reasons for stickiness were cited as the existence of trade unions, the existence of government unemployment benefits, and these factors, according to classical economists, were preventing wages to fall to the level sufficient enough to prompt investment demand, that is, the demand for labor by firms, which would then allow the labor market to clear and allow the economy to return to the full employment level. Keynes, however, noted that the main problem was not that wages were not falling to the level that classical economists wanted them to fall to, but the problem was that when wages do fall, and they did fall considerably in the times of the Great Depression, that when wages do fall, that has a negative impact on firms' outlook for the future. Firms see people earning less, and when they see that, they think that people would be consuming less goods and services. So they see no point in producing more goods and services, and once that happens, then their demand for labor falls. That is, the investment demand for labor in the labor market falls, which causes a leftward shift in the demand curve, warranting a further decline in the wage rate. And therefore, this cycle continues. As the wage rate falls, investment demand falls further for labor, and therefore a new reduction in the wage rate is required. But all this time, you're moving further and further away from the full employment level. That is, the economy is going further and further into recession. That was the main historical difference, or the major historical difference between classical and Keynesian economists. Note that when I say Keynesian economists, I'm essentially referring to John Maynard Keynes and those who subscribed to his policies at that time. Certainly, in the 1930s, Keynesian economics or Keynesian economists, the term didn't quite exist. Keynes was the first one who articulated his ideas formally, put it down in the form of a theory, a thesis, and that is when Keynesian economics and Keynesian economists started. So when I refer to Keynesian economists, I basically mean people, including Keynes, who conformed or believed in the ideas that Keynes had put forward. Now, we analyze 2 major parts to Keynes's insight. The first one was that Keynes viewed unemployment and inflation as the opposite sides of the same coin. So he said you could have a state of unemployment, but that would be characterized or with also a state of deflation. That is, unemployment and deflation go together, and less unemployment and inflation go together, or overemployment and inflation go together. You can't have a state in which unemployment is increasing and inflation is also increasing. At least that was not the situation existing at the time, and I guess Keynes did not think about that. This led to the decline of Keynesian economics in the 1970s, when both unemployment and inflation were seen to rise. That is, the world experienced a phase of stagflation. Stag stands for stagnation, and inflation stood for inflation. And this was caused by the oil price shocks, which caused a supply shock in terms of the rise in the cost of input. Oil was a major input in the production processes and the production and the products of many developed countries, and therefore it increased the cost of production, and this was a negative supply shock. On the other hand, the world fell into recession, and therefore there was unemployment generally, and the two combined to give a state of stagflation. Keynesian macroeconomics could not give an answer immediately to this situation or this problem, and therefore one witnessed a rise in other schools in macroeconomics, and we introduced monetarism, real business cycles, schools, the rational expectations, revolution, and the new classical economists, and we lumped them all together rather crudely and said that these were basically schools which highlighted the importance of the market mechanism and highlighted the importance of micro foundations of macro, rather than merely talking about the relationships between aggregate concepts like unemployment or inflation. So they went to the roots of what caused inflation, what caused unemployment at the micro level. And we also saw that, on the other hand, new Keynesians came forward, and they took the torch of Keynes further, and they said that no, even if you go down to the micro foundations, you can have market failures which can necessitate government intervention. Remember that Keynes was the one who argued strongly for government intervention and said that fiscal policy, that is, increase in government spending or reduction in taxes, could cause aggregate supply to increase when there was slack in the economy. Now, those were broadly the things that we covered in the first 3 lectures. Now I can give you an idea of how the rest of the course will be structured. We will now start with a discussion of national income accounting. We'll talk a little bit about the determination of unemployment and employment, inflation and income in a Keynesian setup. We will then talk a little bit about how fiscal policy and demand increasing policies affect the equilibrium level of output and inflation. Having developed a good understanding of how income, employment and inflation are determined in a Keynesian world, we can then move to a detailed discussion of the 4 big problems in macroeconomics, that is unemployment, inflation, balance of payments problems and growth. And we will also get a chance to discuss the interrelationships between these 4 important macroeconomic issues and concepts. Once we've done that, we'll zoom in on fiscal policy. We'll look at aspects of taxation. We've been talking about fiscal policy and government spending and how it can affect aggregate demand. We'll zoom in a little bit further and look at different types of taxation policies that government can employ and the effects that they have. We'll then look at monetary policy. We'll develop an understanding of the monetary sector. We'll talk about money, money creation, banks, the role that they have to play, and then we'll talk about monetary policy. We'll combine our understanding of fiscal and monetary policy by bringing the goods market and the money market together. We'll take the ISLM approach as well as the aggregate supply, aggregate demand approach to illustrate how equilibrium would change depending on whether there was a monetary expansion or contraction or a fiscal policy expansion or contraction. Once we are through with that, we will be able to look at some issues in international trade and finance, and finally we'll talk about the particular problems of developing countries and the third world, including the problems that Pakistan is facing right now. So, my friends, that's a brief outline of what we will be covering in our next 18 lectures. Let's start by discussing what macroeconomic numbers or statistics are before we try to develop any idea of national income accounting. It's very important to know how macroeconomic statistics are used, how they are abused, because macroeconomic statistics are heavily misused by a number of different people for their own purposes and interests. And it is very important for you as economists to be able to appreciate when numbers are being used properly and when they are being used not properly. So let's take a look at the use and abuse of numbers or statistics in macroeconomics. Now, there is a very famous quote which says that there are lies, damned lies and statistics. इसका तर्जुमा अगर मैं उर्दू में करूं तो वो कुछ ऐसा होगा कि एक होता है झूठ, एक होता है बहुत बड़ा झूठ, और फिर होते हैं स्टैटिस्टिक्स. यानी कि स्टैटिस्टिक्स जो हैं वो बहुत बड़े झूठ की भी अगली स्टेज है. And the idea behind this quote simply is that often statistics can be highly misleading. People might be quoting solid numbers and a lot of fancy graphs, etc. But the type of meaning or that they are trying to convey might be very inaccurate and be based on a wrong or misrepresentation of data or a selective use of data. You might have noticed that the ruling government always seems to come up with numbers to support their case. So the government always says that, any government anywhere in the world always says that the economy is doing fine, we've done this, we've done that, look at these numbers, look at these numbers. And then the opposition at the same time says that, well, the economy is in a terrible shape, and look at what's happening here and look at what's happening here. So, I mean, it seems that the two parties are living in opposite or different economies, right? However, it's the same statistics which are used in different ways to convey different meanings. Similarly, you might have noticed firms and businesses which use numbers or statistics in a way so as to present themselves as performing extremely well. Sometimes you might find banks and other financial institutions reporting their profits in newspapers, and it would seem that their profits are higher than any other bank in the industry. However, every other bank seems to be doing that. So, I mean, there has to be one best bank in the industry. So, again, that involves misrepresentation or selective use of information. Often you find that the bank that you read about in the previous month's newspaper has actually now collapsed, become bankrupt. So that can also happen, and that just shows that statistics, if taken at face value, can be highly misleading. Statistics are also used or abused by pressure groups. So people who are advocating for environmental protection usually present a picture as if everybody, a picture of the environment as if everybody would die from disease the next day. Whereas the government, in trying to counter these pressure groups, like environmental pressure groups, might paint a picture of the environment in which it would seem that we are living in a heavenly garden. So these different presentations or different ways in which data is presented can be highly misleading. You as economists should be careful about it. It's not good for economists to be fooled generally. Economists are deep people. They think deeply, intensely about issues. And it would be very sad if, after having done this course, you could be misled by data or statistics. This is why I'm trying to introduce an understanding of how data can be abused, especially macroeconomics data, so that you are not fooled in your future careers. Now, there are 8 different ways in which economic data, or 8 different issues in the analysis of how data is presented and how data can be interpreted. And there are others as well, but I'm just going to zoom in on these 8, and hopefully they will give you an idea of how same figures, the same statistics can be used and pulled in different directions to convey different meanings. Now, one common tactics that people employ in quoting macroeconomic data, as you know, macroeconomic data is of interest to a lot of people. Data about unemployment, about inflation, about incomes, about the exchange rate is highly sensitive. People assign a lot of importance to this data, and therefore there is a great incentive to use and abuse it. So a lot of times governments or the opposition parties or other groups use selective data in order to make their point. So for example, if the government is trying to boast about its achievements, it might only talk about the particular things it has succeeded in. So it might talk about unemployment if the unemployment rate has gone down, but it might not talk about inflation if the inflation rate has gone up. On the other hand, the opposition might do exactly the opposite. It would talk about the higher inflation, but not talk about the achievement of the government, that is in bringing the unemployment rate down. Similarly, it could happen within sort of categories of information. So the government could say that the inflation rate has gone down, whereas the opposition might focus on a subcategory of inflation and say that food inflation, the prices of foods are going up. So there can be these kinds of selective use of information which can become misleading at times. Another way in which economic or macroeconomic data can be used to convey different impressions, different meanings, is through the use of graphical illustrations. Now, we've been using a lot of graphs in our analysis, but we've been using them honestly in order to convey objectively the concepts that we were trying to illustrate. However, when you put numbers on these graphs and when you're using different scales, graphs can be used in very different ways, and often they can be used to sensationalize issues that are not so sensational, or to non-sensationalize or unsensationalize issues which are actually quite sensational. Let's take a look at an example, a graphical illustration of movements in the exchange rate of hypothetically Pakistan, and see how different presentations or different graphical presentations can convey very different ideas about what's happening to the exchange rate. Let's go to our first slide for today. Now let's take this first graph in which the exchange rate, Pakistani exchange rate, is plotted on the vertical axis against time on the horizontal axis. These are hypothetical figures, just trying to illustrate a point. Now we have the time period from 1990 up till 1999, and we see that the exchange rate expressed as rupees to the dollar climbs from below 25 up to around 60 over the 10-year period. Now the exchange rate does not seem to be rising a lot because of the scale that we've used. Note that the scale starts, the vertical scale starts from 0 and goes up till 90. So the variation in the exchange rate from around 25 to 60 does not seem a lot of variation when you plot it on a scale of 0 to 90. So you can say, well, the exchange rate has lost value, but probably not a lot. However, when you plot the same information and use a different scale, look at this other graph, you have the scale starting from 25, and in this particular scale, the increase or the depreciation in the exchange rate is extremely sharp. And the only reason for that is that you've used a smaller scale. There is no change in the data, it's exactly the same data, but this particular graph is giving a much more dramatic picture of changes in the exchange rate as compared to the first graph. Now the second way in which the same information can convey different feelings is by using absolute versus proportional or proportionate figures. So you can give an example of how the tax burden for an average consumer or an average taxpayer has changed from one year to another. So you can say that the government might be saying that the the tax burden has fallen, whereas the opposition might say, well, the government has increased the tax burden, that is, people are now paying more taxes. Now, are those two versions consistent? Is it possible for the same figures to be consistent with those two opposing figures? The government is saying the tax burden has fallen, the opposition is saying that the average taxpayer is paying more taxes. Well, the answer is yes. Imagine a taxpayer who in this year pays 10,000 rupees in taxes as annual taxes, and his total income is 1 lakh rupees, that is 100,000. Now imagine what happens in the next year where he pays rupees 14,400 in taxes and his total income is rupees 180,000, that is 1,80,000. So his income has increased. Now if you look at the absolute tax payments, there is an increase of 4,400. That is, the absolute tax payment increased from rupees 10,000 in the first year to rupees 14,400. And this is what the opposition is focusing on. It's saying that the tax burden in absolute terms has increased. The person is now paying more taxes. However, if you take proportional figures, that is, if you take taxes paid as a percentage of income earned, then you will note that in the first year, the percentage of income that was devoted to the payment of taxes was 10%. That is 10,000 divided by 1 lakh. Whereas in the next year, the proportion of income devoted to paying taxes was 8%. That is 14,400 divided by 180,000. So the government is right in saying that the tax burden as measured by percentage tax payments has fallen, whereas the opposition is also right by saying that the absolute tax burden in terms of the cash paid in taxes has increased. So again, the same statistics being used to convey two very different pictures. Similarly, when aggregate growth figures or aggregate income figures are being reported, often questions of distribution of income are ignored. So the government or any particular government might be very pleased to report that the overall income has increased and that the average person in the economy is better off. But this might not be the case. And the opposition might point out that no, the average person is actually worse off. Now, depends very much on how you define the average person when you have aggregate figures in your hands, right? And some people use mean as a way of measuring the average. Some people use median. Some people use mode. So there are 2 or 3 different ways of measuring what the average consumer is or what the average income is. Let's illustrate this important point through the use of a simple example. Let's go to our slide. Now let's assume that there are 5 people in the economy, A, B, C, D, E. Under the old government, these 5 people were earning respectively rupees 100, rupees 110, rupees 120, rupees 130, rupees 150. And you can think of these in thousands of rupees. So it's a 1 lakh for the first one, 1 lakh 10,000, etc., etc. So this was the income, the annual income that these individuals were making under an older government. Now let's say a new government comes in, and the incomes that these people now make, the same 5 people, are as follows. Person A is now earning 60, person B is now earning 70, C is earning 75, D is earning 300, and E is earning 450. Now, under the old government, if you calculate the mean income earned, then you can simply divide the total income by 5. That is, the total for the incomes earned under the old government would be 610. You divide it by 5 and you get a mean income of rupees 122. Now the mean under the new government, as you can see, comes out to 191. And this is mainly because the incomes of D and E have really risen from 130 to 300 for D and from 150 to 450 for E. So the mean income being made by the average or the mean person under the new government is 191, which is higher than the first one. So the government might use this figure, the new government, and say that the average person is better off under our government. However, if you talk to the old government might say that it's not the mean that we should look at in order to get a measure of how the average person is doing. We should look at the median income. And the advantage of using the median income would be that we would not be giving too much weight to outliers. Outliers are points at extremities which the mean measure of average gives a lot of weight to. However, if you use the median approach, that is, you sort the incomes in ascending order, and then you simply pick the person who sits right in the middle of that sorted list, then you get person C under the old government was making 120 rupees, whereas person C under the new government is making 75. And therefore the median income, or the average person as measured by the median income, has actually fallen. That is, the income has fallen from 120 rupees to 75 rupees. So the opposition might say, or the earlier government might say, that the older government was better and that the new government has caused the living standards of the average consumer to fall. Now, a fifth important point to note about the data that you are looking at is whether the data is real or nominal. Now, nominal data is any data which is expressed in money terms, whereas real data can be expressed in money terms, but it points to the underlying real economic size of what you are measuring. So if you're talking about, let's say, real GDP, then you're talking about the real amount or quantity of goods and services produced in the economy. Whereas if you're talking about nominal GDP, then you're talking about that quantity multiplied by the price level or by the respective prices. So real relates to the underlying real activity or real output that is being measured, whereas nominal relates to the money value. And as you know, money loses its value. So the distinction between real and nominal figures can become quite important, where money is losing its value or gaining in value very fast. Let's illustrate through a simple example. Let's say that incomes in a particular country have increased by 15%. Let's say your income has increased by 15%. You earned 100 rupees a week or an hour last year. Now you are earning 118 rupees, right? So you're earning 115 rupees. That is, you're earning 15% more. However, let's now imagine that at the same time during this year, prices of goods and services have increased by 18%. So that means that everything that you could buy for rupees 100 last year now costs you rupees 118. 100 plus 18% of 100. So you are now earning 115 rupees. That is, your incomes have gone up by 15%, but you cannot buy the same quantity of goods and services that you could buy in the previous year. That is, you are worse off. You are not as well off as you were in the previous year. You can now buy 3% less goods and services. So it's very important to know which person is citing which figure, whether he's citing real figures or nominal figures. Now, another way in which people can use the same data set, the same figures, but lead you to different conclusions is by using different comparison periods. So you could say that the income or the GDP growth rate of a country between 1982 or 1986 was 3.5%, whereas when you look at the comparison of the GDP growth rate over a longer period, let's say 1979 to 1986, then or 1987, then that GDP growth rate might fall to 1.5%, because the economy had not done so well in the end years, the 1979, 80, 81, and 1986 years. So these kinds of things, the differences in comparison periods, can cause the same data to give very different pictures. Let's look at a small example to illustrate this. Now here, the real GDP growth rates of a country are given over the 1979 to 1986 period. Now, as you can see, if you take the average of the growth rates from 1982 to 1985, then the average that you get is 3.5% per year, right? Which is 3% plus 4% plus 5% plus 2% all divided by 4. However, if you take the longer period from 1979 to 1986 and total all those growth rates up and then divide by the new number, which is 8, then you will get a growth rate of 1.5%. So by just using different time scales or the time periods for comparison, you can get very different answers about how well the economy has done. Now, another important point to note about macroeconomic figures, especially GDP or income figures, is to see whether they are presented in aggregate terms or per capita terms. Per capita basically means the total figure, the total number, the total income divided by the size of the population. So if the total income of a country is, let's say, 1 billion, and then if the population is, let's say, 1 million, then the per capita income of that country will be 1 billion divided by 1 million, which gives you 1,000. And this is a measure of the average income per person in the economy. Now, let me show you how important this distinction can become when reporting macroeconomic figures. So think of the example of Switzerland versus China. As you know, Switzerland is a small country and China is a very large country in terms of population. Now, in 1992, the total GDP or the total income of Switzerland was $241 billion, right? That's pretty big. But China's was over $500 billion, something like $509 billion. So at the surface or a superficial eye would say that China or the average person in China might be richer than the average person in Switzerland. That is, Chinese people are better off than people in Switzerland. But note that the population of China is 1 billion people, ek Arab Admi. That was in 1992, whereas the population of Switzerland is only about 6.67 million. That is less than the population of even one city in China, that is Beijing, or even less than the population of Karachi, 66, 6 lakh, ya 60 lakh, to kuch bhi nahi hai. So if you divide the total figures, 241 billion, by the size of the Switzerland population, and if you divide the Chinese total by the size of the Chinese population, then you get per capita income figures which are drastically different. So for Switzerland, you get a per capita income of about $36,000, whereas for China, the equivalent figure is only $470. And suddenly the whole picture changes. We were earlier saying that Chinese people might be better off than Swiss people, but now when you take a measure of the per capita income, the Swiss average Swiss person is 160 times richer than the average Chinese person. So it makes a lot of difference if you're using per capita figures or aggregate figures. Now, this distinction between total and per capita can become very important when we are talking about growth rates. So if the growth rate of a particular country, let's say the growth rate of GDP is 2.5%, but its population growth rate over the same period is 3%, then the net growth rate, that is the growth rate adjusted for population, would be minus 0.5%. That is, in a way, the economy for in a per capita sense has contracted, not expanded by 2.5%. So these are all the ways in which you should be careful about how data is being used. Make sure that you know exactly whether the data is real or nominal, whether it is per capita or total, what is the time period for analysis, if the data is presented in graphical form, what is the scale being used. These distinctions will make you better able to make informed judgments about particular data sets, particular figures. Otherwise, you might be fooled into believing something which is not true. So that was our brief discussion on how macroeconomic data can be used or abused. Now, all this time we've been talking about incomes, if you remember, total output, income, aggregate demand, aggregate supply, and some of you might be wondering what do these terms actually mean? Obviously, we need to come up with a formal measure of total national income or total national product, and this is exactly what we will do in our next stage. And this we will do by introducing national income accounting. Now note that national income accounting in itself does not have any Keynesian or classical connotations. National income accounting is a neutral way, a methodology of making sense of the individual figures on industries and consumption figures or investment demand figures that the government has. So you have all these figures in different markets, all this product being the domestic product being produced by different firms. And national income accounting is just a way of consolidating that information into one figure, which can then be used as a representation or a measure of the overall level of activity in the economy. Now, the figure that is most commonly used is that of gross domestic product. Gross domestic product simply means the total amount of goods and services produced in an economy during a period of time. When you say during a period of time, this implies that GDP or gross domestic product is a flow figure, not a stock figure. Now, some of you might already be aware of the difference between flows and stocks. Flow figures are those figures which accrue over a period of time, whereas stock is something which can be pointed at any particular date. I'll give you an example. If there is a bank which opens today and starts collecting deposits on a daily basis, so it collects 100 rupees today, another 200 rupees tomorrow, another 300 rupees the day after, then the flow in the during the first day is 100, the flow in the second day is 200, the flow for the third day is 300. But the stock of deposits at the end of the third day, and you can point a finger at that date and say that the stock of deposits at the end of the third day is rupees 600. So this is the difference between flow and stock figures. GDP is a flow measure, so it relates to the amount of goods and services produced during a period of time or during a year. Year is usually the time period that we are talking about. So this, once we've developed an understanding of GDP and applied it to a particular economy, we can then immediately see how, if the same concept or if the same measure was consistently applied to other countries, then comparisons, useful comparisons can be made between the economic activity or the level of economic activity of one country and another country. Note that if different accounting measures were used by different countries, if some country was using GDP, another country was using some other accounting measure, then it would be difficult to compare the two countries. But because there's a national income accounting convention by which most countries use GDP or related concepts, then it becomes related measures, it becomes easier to compare the level of economic activity across different countries. Now, how can GDP be measured? We've been talking about GDP, but we have not so far talked about how it actually is measured in any particular economy. Now, there are three identical ways, three equivalent ways of measuring GDP. GDP can either be measured through the value added approach, right? Or it can be measured through the expenditures approach, or it can be measured through the incomes approach. And the concept here basically is that whenever we are talking about an economy, we should have the circular flow of incomes and goods at the back of our mind. If you remember, this was introduced in the first lecture of this course, when I introduced that goods and services flow from firms to households, and households use their consumption expenditure to buy those goods and services, but households are given incomes by firms in return for the factor services that they provide to firms, like labor, land, capital, entrepreneurship, and the incomes they receive in the form of wages, rent, interest, and profits is what they use to consume on the goods and services. So note that these three concepts are very closely related. The goods and services that are being produced by firms, the expenditure on those goods and services by households, and the incomes that households receive. These three concepts should be equivalent, because the goods and services that the firms produce, the value of those goods and services should be exactly equal to the amount of money that consumers are spending on those goods and services. But on the other hand, what consumers spend is what they earn. They can't spend more than what they earn. So the amount that consumers spend, that is consumer expenditure, should be equal to the incomes that they receive. And this is exactly what is being said here. Value added or product approach merely captures the amount of or the quantity of goods and services that is produced, right? So that's the value that firms add to the inputs and to the products that they process and then produce final products for the consumption of consumers or other firms. The value added, the total value added by all the firms in the economy gives the total quantity of goods and services that are produced. This then is equal to the total expenditure by consumers on final goods. As you know, consumers only spend money on final goods. Firms might buy intermediate goods from other firms, but consumers are only interested in final goods. Then the consumer expenditure should also be equal to the incomes that consumers receive, mainly because incomes or factor incomes are equal to the value added by any firm. So note that if a firm buys a raw material for rupees 1,000 and then uses labor and capital to process that raw material and turn it into, let's say, a product which can then be sold to the final consumer, and let's say the value added or the cost of wages or the cost of capital adds to about 500 rupees, then you add the 500 to the original cost. So 500 would be the value added by the firm, but that 500 is exactly the factor incomes that have to be paid to households. Now this 500 could also include the profits that is being distributed to households, but profit, as you know, is just another form of incomes or economic cost that has to be paid for the use of economic factors. So value added is conceptually equal to the factor incomes that households earn. And because value added translates into the total output that a firm or the economy produces, that should be equal to the expenditures. This is how the three approaches are equivalent. This was how I said it in words. Now let's see how we can illustrate this through the use of some numerical examples. Let's go to some slides. Now let's assume that there are only three firms in the economy: Firm A, Firm B, and Firm C. Firm A produces steel from raw iron and sells it, let's say, for rupees 100,000 to Firm B. Firm B buys the steel worth rupees 100,000 from Firm A and then processes it to produce a car body, the body of a car worth rupees 200,000. That is, the body of the car is worth rupees 200,000. Firm C, which is the final assembly firm, which assembles all the parts of the car together, buys the body of the car from Firm B at rupees 200,000, the rupees 200,000 price, and then adds the different parts, assembles those different parts together, and sells the completed car or the full car in consumable form for rupees 450,000. This is the price that the car fetches in the market. Now, what is the value added or GDP in this case? Now, if you just add the value that each person or the total value of sales made by all of the firms, you will get 100,000 for Firm A, 200,000 for Firm B, and 450,000 for Firm C. So the total amount of transactions or value of transactions in this case is equal to 750. But note that this is not the GDP in the economy. The GDP for the economy would be the sum of the value added by each of the firms. So firm A adds value worth rupees 100,000. It buys raw material which has very little value, then it adds rupees 100,000 worth of value and then sells it for 100,000 to firm B. Now firm B's value added is not 200,000. Its value added is 200,000 minus the price at which it bought the raw material. And the raw material for firm B is of course steel, not raw iron. So the value added for firm B is 100,000. Similarly, the value added for firm C, which is the assembly plant or where the assembly plant is located, is not rupees 450,000. It is rupees 450,000 minus the price at which firm C bought the car body for rupees 200,000. And therefore the value added for firm C is 250,000. If you total these three value addeds, you will get 450,000 rupees, which is the GDP in this case. Now rupees 450,000, as you will note, is also equal to the total expenditure on the final goods made by consumers. 450,000 is the price of the car, right? And consumers buy this car. So the total expenditure of consumers on this final product is rupees 450,000, and that is exactly equal to the sum of the value added. So this establishes the equality of the value added and the expenditure approaches to the measurement of GDP. Now let's look at how the factor incomes approach would also give the same answer. Note that the factor incomes in this case that would be earned would also give you an answer of rupees 450,000. For firm A, the value added is rupees 100,000. But what is this value added? This value added is simply the costs that the firm incurs in transforming the raw iron into steel form, and the costs are wages, rental value of land, the capital cost, profits also. So that 100,000 is basically the factor incomes that would be distributed to households in the form of wages, rent, interest and profits. However, if you look at firm B, the value added for firm B would be from 100,000 to 200,000. So the value added again is 100,000, and again this is nothing but factor incomes accruing in the form of wages, interest, profits and the return on capital interest. So similarly for the final firm C, the value added would be 250,000, and that's again equal to the factor incomes that will be earned by households. So this simple example establishes how the three approaches to measuring GDP are identical. If you look at it from a conceptual way, total output, the total domestic product, is equal to total expenditure by consumers is equal to total incomes that households receive. This is equivalent to saying that the total output or aggregate supply in the economy is equal to aggregate demand. Aggregate demand is related to expenditure. So when consumers spend money on goods and services, they generate the demand for the aggregate supply or output that has been produced by firms. And finally, the total income, factor incomes that households earn is equal to the national income or the total income that the economy as a whole earns. So when you say that total product is equal to, or total value added is equal to total expenditure is equal to total factor incomes, you're essentially saying aggregate supply is equal to aggregate demand is equal to national income. And this is why we sometimes use these terms interchangeably. They usually refer to the same thing, especially when the economy is in equilibrium. That is when aggregate demand is equal to aggregate supply. Now the example that I just cited is a pretty simple example and might not bring out some of the complexities that actually exist in the real world. For this, let's revert to a more complicated example. It's an extension of the example that I gave. So again, we have a steel manufacturer, a car producer, we also have a tires producer, and we have the final consumers. and we see how when these different producers and consumers or buyers get together in a real economy, the kinds of interactions or the kinds of transactions that take place, and how we can then develop the three measures of GDP, that is the total value added measure, the total expenditures measure, and the total factor incomes measure. The key thing to note in this example, we will only set this example up today. We will discuss its implications in our next lecture. We will set it up today, but the key thing to note is that some of the firms here, like let's say the car producing firm, will buy goods from the steel producing firm and use them sometimes as inputs or sometimes as final goods. So if it buys a machine, let's say from a machine producer, and then keeps it with it, then the firm becomes the final consumer, right? So this is the key difference to note. The final consumption refers to a state in which a good is consumed and it is not consumed thereafter by anybody else. So if a firm buys a machine and then keeps it with it for consumption till ever, or for usage till whatever time the machine expires, then that will be referred to as a final consumption. Similarly, when a car is purchased by a consumer and then consumed till ever, then that's the final consumption. Let's set this example up, and then we will refer to it when we come back in our next lecture. Let's go to our slide. Now, this is an example of our new, more complex hypothetical economy. We have four types of producers in this economy. We have the steel producer, the machine producer, a tires producer, and a car producer. We also have the final consumer. So there are basically five parties or five different players. We have four columns in this slide. We'll add three more columns in our next lecture when we analyze this information. The first column refers to the good regarding which the transaction is taking place. So we have steel, machines, tires, cars. The second column refers to the seller. So if the steel producer is selling steel to the machine producer, then he would appear as the seller and the machine producer would appear as the buyer. Similarly, we have the other transactions between the steel producer and the machine producer and the cars producer and the cars producer and the steel producer. Then in the fourth column, we have the value of the transactions that are taking place. Note that each of these transactions has a different value. So you have the steel producer selling steel to the machine producer for 100,000. The steel producer selling steel to the car producer for 300,000. The machine producer selling the machine to the car producer for 200,000, etc., etc. The total transaction value is 1,150,000. That is 1,150,000. But note that this should not be equal to GDP because GDP is merely the value added. We have to sift the value added from this example in order to get a measure of the GDP of the economy. So my friends, we will return to that example in our next lecture. I would be very happy if some of you went home and made those additional three columns of value added, of expenditure on final goods, or on the total factor incomes that could be earned, hypothetical values, and see if the total GDP that you obtain using those three approaches is equal. We will, however, come back to this formally in our next lecture. Now, that was it for today. We will do a little recap and conclude. In doing a recap, let's recall that we started our discussion by looking at the different problems that one encountered in interpreting data that was quoted. Statistics about macroeconomic concepts, macroeconomic issues, about unemployment, inflation, incomes. These statistics could be very misleading or very misrepresenting if one did not know what the different ways in which the information was presented were. So you had to make the distinction between real or nominal data. You had to make the distinction between aggregate and per capita. You had to know what scale was being used. You had to then know whether the growth rate was net of the growth rate in population, and a number of other factors before you could make an informed or form an informed opinion about what the data was really saying. Then we developed basic ideas about national income accounting. We noted that the GDP, the gross domestic product figure, was used as the central figure or the central measure of the total level of economic activity in a country, that the GDP was a flow figure, not a stock figure, that it could be measured in three equivalent ways, that is the value added approach, the value added method, the expenditures method, and the factor incomes method. And we looked at some examples of that. With that, my friends, we come to the end of today's lecture. Now, if you notice, we have taken a U-turn. We were earlier discussing history and concepts and ideas and debates between schools of thought, classical economists, Keynes, and now suddenly we are discussing numbers, dollars, values. This is all part of macroeconomics. If you want a good command, then you need to understand the data, and then you need to understand the process or the concepts, the theories which are generating those data. They are two sides of the same coin. So you need to understand both. So I hope some of you have found the courage to try to attempt the questions that I've put on the web, and that you're enjoying them. I look forward to meeting you again. Till then, it's Khuda Hafiz and Assalamu Alaikum.